Okay, good morning, everyone. I am not, as the program indicates, Bob Rawson. Unfortunately, Bob has to be away today. I'm Jonathan Enton. I'm Associate Dean for Academic Affairs here at the Law School, and on behalf of Case Western Reserve University School of Law, I'd like to welcome you to this year's George A. Leet Business Law Symposium. The symposium was endowed by George Leet, who was a member of the class of 1946 and who was a very dedicated and generous supporter in many ways of the university and of the law school. The program, the Leet Symposium, is sponsored by the Center for Business Law and Regulation, which is one of a number of centers of excellence here at the law school. And as I said, my main function here is to welcome you all and to wish you a very productive day. I know that my colleague George Dent, who has taken the lead in organizing this session, has done a terrific job both this year and in the past symposia. George is the Schott Van den Enden professor here at the law school. He is a leading scholar in the business and corporate law area. And with that, let me turn things over to George to get things going. As I said, I wish you all a very productive day, and I'm sure you'll have one. So, George?
As John said, I put together the program for today, and I don't think anyone is going to disagree with me that one of the most fruitful sources of controversy in the corporate area is the controversies over the role of institutional investors. I think all one has to do is say hedge fund to start people bristling in the corporate area. So I've put together this program on the theme of institutional investors in corporate governance, heroes or villains. I'm delighted with the panel I've managed to put together here. I'll say, by the way, that those who were able to arrive in time last night from out of town, I took them to dinner at L'Albatross, and then we walked down the street to the orchestra concert at Severance Hall, which they all properly admired. So I think I've given them a good impression of Cleveland. For the main speaker for our, we've got three sessions today, and the main speaker for the first session is John Wilcox, who is chairman of Sodali Limited, an international investor advisory consulting firm, and former senior vice president and head of corporate governance for TIAA-CREF, who will give us an institutional investor's perspective on these issues. And he will be followed as commentators by Katherine, who is senior vice president for corporate governance, corporate secretary, and deputy general counsel for Exelon Corporation, a large utility based in Chicago. And then as the second commentator, Professor Simon Peck of our own Weatherhead School of Management. I want to say that I have encouraged the commentators that they should not feel obliged to give a point-by-point response to the presentation of the main speaker. I think it is more fruitful to get the best people I can get and to let them talk about what they think is important and interesting. And that is what I've asked them to do. I've asked the main speakers to talk for about 25 to 30 minutes each, and the commentators to talk for about 15 minutes each, and then to leave the rest of the session for colloquy among the speakers and for questions and comments from the audience and responses. So, again, I'm delighted to begin with John Wilcox.
Shall I use that, or should I stay up here? Does it matter?
Wherever you would like wherever you would feel more comfortable.
Well, I think the audience can probably hear me. I guess we have microphones here, so I'll stay here because I think what's going to be most interesting for all of you is to hear us talk amongst ourselves. So I will keep my comments to 20 minutes, I hope. Stop me if I'm rambling. Let me begin by saying that while that my career has involved work on behalf of corporations for more than 30 years, I was working as a service provider to corporations. Then I went to work at TIAA-CREF, where I represented the viewpoint of a very conservative but progressive long-term institutional shareholder, and one that takes its responsibilities as an owner very seriously. TIAA-CREF is also a not-for-profit entity. It was founded in 1918 by Andrew Carnegie, of all people, and its mission is very clear, which is to advance the cause of education and the economic security of educators. And it was started with the awareness that there was no pension system for educators, and who were at that time some of the most valued members of U.S. society. And so TIAA-CREF is a very mission-driven place. And so I represent in my thinking a very positive view of owners who behave responsibly with a long-term outlook. I also bring an understanding of the problems that corporations face in running businesses day to day, in competing and trying to achieve good economic performance in very difficult circumstances sometimes, such as what we now have. So I'm not going to defend hedge funds and others, but I feel very strongly that the responsibility of dealing with all shareholders falls on the corporation. It is part of the job. It is an assumption that is implicit when a company decides to go public and to accept capital from the larger universe of public investors rather than just from private sources. It takes on a set of responsibilities that it must deal with seriously. So I have 7 points I'm going to make, so I'm going to tell you what they are, then I'll expand a little bit on them, and then we can get into comment. First of all, I've entitled this talk whether we're looking in corporate governance at institutional investors as villains or heroes. I see them as reluctant heroes, and with the emphasis on the term reluctant, because and the reason why I think they're heroes is because they have faced up to the issues, some of the inefficiencies and the problems, whereas companies, and this is my second point, have generally been on the defensive with respect to shareholders. They tend to be a little bit more backward-looking. If you look at the commentary of people such as Marty Lipton, lawyer from Wachtell Lipton in New York, who's one of the most aggressive spokesmen for a viewpoint that views shareholders as bad guys and companies as good guys, and sees the conflict between companies and shareholders as a war, as a power struggle. In my view, many of the attitudes that he represents are attitudes of looking back at how great things were in the past, as opposed to embracing the problem and looking forward, looking for ways to deal with it, the more constructive approach. So the shareholders over the past 25 years, really, because 1985 or 1987 are the dates that are used really as the start of the corporate governance movement. 1985 is the year that ISS was founded, the year that the Council of Institutional Investors was founded. That was the start of the organizing of large institutions. And that 1987 more because that was the year in which there was the first shareholder proposal sponsored by a large institution. It was CalPERS. And prior to that, Rule 14A8 shareholder proposals had really been exclusively the domain of gadflies and individuals and special interest groups. So in the year 1987, we started to see shareholder resolutions used as a tool by large institutions. And you know where we are now. There are hundreds and hundreds of them getting majority votes in many cases, very high votes in others, dealing with very concrete issues of broad concern. So my first point is that the institutional investors are reluctant heroes. They're heroes because they have faced up to the issues, and reluctant in part because they don't want to play this role. They would rather have the company play it. They'd rather not have to interfere. But also reluctant because they haven't looked in the mirror. And I'll get to that in a later point. Second point, again, companies have been largely on the defensive and have kind of perpetuated an adversarial relationship with shareholders rather than the kind of constructive relationship that they bring to problems from customers. My third point is that corporate governance reforms that have occurred in those 20-odd years, 25 years since 1985, 87, have the appearance of being kind of a mixed bag of shareholder rights, best practices, many of them global, regulatory enhancements, and efforts to harmonize rules in different states or even globally. But in essence, it seems to me that the thrust of corporate governance reforms all point in one direction, and that is to redefine the role, responsibilities, and accountability of boards of directors. This, in my view, is what corporate governance and what shareholder activism is all about. And again, I'm not talking about activism in terms of a takeover bid or a particular disagreement over strategy. I'm talking about the effort to strengthen shareholder rights, to improve regulation, to create standards of good governance. All of these, it seems to me, are aimed at increasing the responsibilities of the board of directors, clarifying them, and making sure that directors are accountable. Here again, I differ with someone like Marty Lipton because he says that the effort on the part of corporate governance is to make the corporation shareholder-centric. I think that the struggle has really been between a sort of management-centric view of the corporation versus a board-centric view. And in a moment, I'll take a look at the one slide I have, which is the corporate governance triangle, to talk to you about why I think a director-centric model is the one that shareholders want. And the idea that there's a struggle between the director-centric model and a supposedly shareholder-centric model is inaccurate. What we should all want is a director-centric model. So I think that needs to be thought about a great deal. What is it that we expect of boards of directors, and are they capable of doing all that we expect of them, and how should they be empowered, and what kind of an environment do they need, and how do we need to change boards so that they can fulfill all of these responsibilities? Because in my view, this is a one-way street. Directors are going to have more and more demands put upon them. It's becoming more and more of a job as opposed to an advisory and sort of honorific role. My fourth point is that a truly director-centric governance model will actually change the culture of corporations and will redefine the role of the chief executive officer as well. I am one who has come, again, reluctantly, to the view that a split between the chair and the chief executive officer is necessary. In this country, we've really conducted a very long debate, which I think is a debate without much content. It's really more about a belief or a conviction that the CEO, that one person needs to embody the power of the corporation. And yet at the same time, we would have no trouble arguing that if we've got a difficult problem to solve, two heads are usually better than one. The assumption that if the CEO and the chair are split, you will automatically have a situation where there's competition for decision-making seems to me a very arbitrary conclusion. And that if we do it right, a chairman should be working collaboratively and collegially with a CEO. The CEO can then focus his or her efforts on running the business. And there are so many issues that the board of directors must deal with that involve the resolution of conflicts of interest, that to put the CEO in the position of also being chair and having to remove the CEO's hat at the moment when a mediating decision must be made or a conflict must be resolved is asking too much of any single individual. My fifth point is that director-centric corporations will redefine their relationship with Wall Street. We have lived through 20 years of the tail wagging the dog, where corporations run around and wring their hands and use every tool in the book. Some of them are fraudulent, some of them manipulative, in order to sort of meet the consensus number on Wall Street. In my view, that is 180 degrees wrong. What should be happening is that the company runs its business, it is transparent, it does its disclosures. If Wall Street gets it wrong, then Wall Street has gotten it wrong. The company should not be targeting Wall Street numbers. Instead, Wall Street should be held accountable if it fails to do a decent job of analyzing the company. Some of this problem goes way back to 1976-77 when we got rid of fixed commissions and independent analysis kind of dried up because there wasn't anything to pay for it anymore on Wall Street. We started to mix fundamental analysis in with underwriting and other investment banking functions, and Wall Street stopped doing its job as independently and as well as it had traditionally done it. But strangely enough, Wall Street was not held to task. Instead, companies were held to task. And companies started to get involved in whisper numbers, and we went through Reg FD and lots of other sort of strange gyrations. We knew that what we were doing was wrong, but nevertheless, there was a kind of drift and a failure of both regulation and standards on the part of the Securities and Exchange Commission and Wall Street and companies, and we started to allow companies to operate for Wall Street numbers. That's no way to run a business. You have a CEO with one eye on Wall Street, you have a CEO with only one eye on the company. That's not right. And it's going to take us a long time to get out of those habits, and those habits were directly contributing to the short-termism that we've been worrying about for at least a decade and have been powerless to correct. I think also that another change, aside from making companies think differently about Wall Street, I think that a director-centric company becomes one in which communications between directors and shareholders, direct communications, become more feasible. I am a part of an ABA committee, the ABA Committee on Corporate Laws, whose primary function is to look after the MBCA, the Model Business Corporation Act. And however, we have a committee of the whole that is looking at the issue of the relationship between companies and shareholders, directors and shareholders. And this is really more a state law issue than it is a federal law issue, so it's a proper issue for the Committee on Corporate Laws to look at. And there are lots of sort of worries about director communication with shareholders, but most of them are quite superficial. The larger issue is, in a sense, a democratic one, which is that the elected representatives of a constituency ought to be able to communicate with that constituency. We do have Reg FD issues. We've got a number of concerns about companies not speaking with different voices, particularly in critical situations. All of those things are relatively easy to deal with, and yet we're still sort of here, again, it's the companies that are reluctant. We still are raising lots of worries. When Pfizer had its meeting between the heads of its standing committees and a group of its 30 largest shareholders on October 24th, 2007, that move was criticized by many lawyers and by many other companies. It was called corporate governance run amok. Well, when we're in this country saying that a conversation which included general counsel between these heads of standing committee of board of directors and its major institutional shareholders is wrong, we have to start re-examining some of our assumptions. And I think we're going to see much more of this. It's needed, it can be controlled, and it will be genuinely useful. I do most of my work outside of the U.S. now because my company is a service provider to corporations in continental Europe and Latin America. But in the U.S., where I am continuing to be primarily an advocate for governance reform and for an advocate for change, I do work for a few companies privately. And what I find is that there is often a disconnect between what shareholders think about the company, the way the company is perceived, and the way the company really is. And there are lots of reasons for that. I'm doing some work now for a very, very progressive company that is trying very hard to do things right and in line with what shareholders want. But it isn't effective in dealing with shareholders in a direct way. And of course, we have the problems of SEC-mandated disclosure. We have the problems of lawyers writing communications. We have the problems of fear of liability that interfere with candor. But candor is needed, and there's nothing like getting individuals into a room together so we get the sort of feel of the character of the people in order to eliminate some of the suspicions and fears that lead to all of this adversarial conduct, which is very costly and very inefficient and time-consuming, and which takes the place of a real focus on the business. My sixth point is that I said that the institutional investors are reluctant because they haven't looked in the mirror. Well, my sixth point is that I think that the mirror is going to be held up to the institutional investor community. It's long overdue. We keep seeing little issues arise. I don't know how many of you read the Sunday New York Times business section, but there was an excellent article authored by Gretchen Morgenson, who's a very aggressive columnist, one of the people most hated by corporate America and most loved by shareholders. And it was an interview with John Bogle, the founder of Vanguard. And he pointed out very clearly some of the problems within the mutual fund industry. I am also a director of something called the Share Owner Education Network, which is a newly formed group. We co-sponsored some research that was published about a week ago, done by the Corporate Library, which also sponsored it, and also AFSCME, the union pension fund. And that report looked at the voting record of mutual funds and was very critical of their conduct from a shareholder viewpoint. And I think that the institutional investor community, particularly mutual funds, suffer from some of the worst corporate governance you could possibly imagine. And it's always been a puzzlement to me why corporations haven't been more aggressive in seeking to impose on institutional investors the standards that are imposed on them. Why aren't institutional investors, which are fiduciaries, just as companies' boards are fiduciaries, held to fiduciary standards? Why aren't they required to have the kind of transparency that we require of corporations? Why are directors of mutual funds entitled to sit on several hundred fund boards and take home paychecks far higher than anything collected by any corporate directors and not be criticized? Why is that permitted? So I think we need to look at that side of the equation as well. And my final point is that there are a number of very interesting hot topics today, such as shareholder access, say on pay, other issues in which shareholders and corporations are engaged in pitched battles. But in fact, I think for all of these issues, there are solutions that work to the benefit of both. That ultimately shareholders and corporations want the same thing, which is economic performance. We all want to get rich through having the companies in which we invest, whether as employees or as contributors of capital. We want those companies to perform well, to have their stock price go up so that we're all happy. Given that common economic goal, why is it that we quarrel all the time? And I think the blame is in part because of the legal structure in the United States, which goes back 80 years, which was set up at a time when shareholders were small and powerless and widely dispersed and subject to abuse by large and economically powerful corporations. There was a reason for the rules having the structure that we see in the 33 and the 34 Act. Today, however, the institutional investors are larger and more economically powerful than the corporations they own, and yet the same legal structure is in place. That doesn't make that much sense. It perpetuates peculiar behavior on both sides. Large institutional investors who are extremely sophisticated still hide behind the mantle of the small shareholder, and yet they themselves are not protecting the small investors whose assets have been entrusted to them. So I think these are issues that on which shareholders, there are many issues, and we can talk about these hot topics amongst ourselves. These are very many issues on which we should be seeking agreement rather than continuing to fight. Now, I'd like to just take a look at the one slide, and then I will conclude. How do I turn that on? It's the corporate governance triangle. Is it in the form of a slide? If not, you can simply look at your book. This is a graphic that I think is very useful to understand how a corporation should work.
Is it this one?
It's.
Reformat.
I have no idea where it's because I just sent it here. Either.
Bottom one, because that's not. It's not that one.
All right, it's not on there. Look, just use your the handout because there's a picture of this document. This should actually be an equilateral triangle rather than it's a slightly squashed triangle here. But the idea of this document and its usefulness in thinking about the issues that we're discussing here is that we need to think of the corporation as a dynamic enterprise in which each of the three power groups, the shareholders, the management, and the directors, all contribute things, and they all have responsibilities as well. And the arrows that run from, let's take the shareholders now. The shareholders put the capital into the company, and that company runs towards management, and management really represents the corporation as a business and the enterprise. And in exchange for that, the shareholders expect dividend payments, growth in value of the stock price, and the fulfillment of certain responsibilities, disclosure. And then I have investor relations as a two-way arrow because we can't quite decide how that works. It does run largely from the corporation to shareholders in its professional form. But on the other hand, shareholders do have a lot of input. And in places like the UK, this arrow is definitely a two-way street. And it should be a two-way street, given the size and the sophistication of shareholders today. Looking at the axis running from management up to directors, the directors oversee the whole business, really, the enterprise and the management. And I think management owes performance. I could probably spend a bit more time on this axis, on this relationship. But increasingly, the demands that are being made by shareholders on the board of directors are focused on having boards explain how their policies and how their actions, particularly in areas such as executive compensation, are linked to strategy. And one of the responsibilities that I think is going to increase with boards of directors is that they're going to have to understand how the businesses that they oversee actually work, how they make money, and how their little tweakings in terms of incentives in compensation and how succession planning and other things really do affect these businesses they oversee or do not. And they need to be more deeply rooted in their understanding of the business. And that's risk management, which is another issue that we're involved in. And the problems that we saw in the financial industry arose because directors didn't understand the products that were driving their business. When you look at the Merrill Lynch's and the AIGs of this world, they were peddling products and making tons of money from them. They didn't understand what the heck it was that they were creating, what was in those packages, and what risks there were for the businesses that they were supposedly overseeing. That's unacceptable. They need to know more. They need to understand more. And here again, another reason why I think the CEO and the chair can't be the same person. The CEO needs to educate the board, and the board needs to make objective decisions on matters of risk and conflicted issues such as executive comp. Looking now, finally, at the axis running from shareholders to directors. The shareholders elect directors. This is a meaningful action. It's been treated as a largely symbolic action, but it is indeed meaningful. And there are consequences of that. The directors must represent the shareholders. I don't like the term agent. I don't think directors are the agents of shareholders, but they represent shareholders. Then they have clear fiduciary responsibility to them. The arrow communication running both ways. In some of these charts, I have that with a sort of a dotted outline because it doesn't work very well. It needs to work better. Finally, the arrow that runs directly down from the director apex down to the midpoint in the axis between shareholders and management is intended to emphasize the increasingly important role of the board in resolving conflicts of interest. There are lots of them, and they are conflicts in which both sides are right. It's not that the shareholders are wrong and the management's right, or the management's wrong and the shareholders are right. They naturally pull in different directions on the issues, and I have a list of some of them here. Executive comp, control issues, capital issues, raising more capital. The company wants more capital. The shareholders don't want to be diluted. So, all right, how do you resolve that issue? Well, you can resolve it. You must resolve it because you want the business to grow. But you've got to make the arguments, and then you have to articulate to the shareholders, particularly if they have a vote, if they have to approve it, why it's in their interest. And that hasn't been done as well as it needs to be done. So the scaling triangle at the bottom, I think, is the way things used to look 25 years ago and still look at some companies. This is the way it looks in Europe and other developing areas of the world. The directors and the management are right there together with each other, and the shareholders are out in left field. But what we should all be striving for is an equilateral triangle in which all parties' interests are looked after because they are, in fact, all trying to achieve the same economic objective. So I'll stop there.
Can everybody hear me? Hi, I want to join in thanking you all for your hospitality. It's really nice to be here. I haven't been to Cleveland in quite some time, and I've enjoyed everything. We got to see this orchestra last night and your beautiful buildings, and thank you very much for the hospitality. I work for Exelon Corporation, which is the largest operator of nuclear generation in the United States. According to benchmark performance criteria, the best performing nuclear operator in the United States. And we have, it was formed in 2000 by a merger of two large utilities, one in Philadelphia, one in Chicago. The service territories are largely concentrated in the Mid-Atlantic area and the Chicago, northern part of Chicago area, of Illinois. We have over $19 billion in revenues and retail shareholders over 450,000. About half of them are institutional. So we're very heavily owned by institutional shareholders and spend quite a bit of time getting to know them and showing them how grateful we are for their confidence in us. We have back when we were two different companies, we were largely not on the radar screen for investors. We had only the gadfly proposals, and so our annual meetings were relatively focused on regulatory issues. Abby Hoffman protesting the construction of Point Pleasant pumping station and things of that nature. So corporate governance was not a core function, wasn't perceived to be a need. We followed what we understood to be best practices by benchmarking other companies, and were very careful to stay within them because we believe in excellence in all we do. So the same kinds of standards that are applied to our nuclear units are applied to our side of the shop, including shareholder services and ethics and all the other things that we manage. But I'll never forget the CalPERS letter where they asked people, will you agree with these governance principles or not? And many companies ignored the letter and found to their dismay that they had to explain to their board why they got an F or however CalPERS graded people who didn't respond. So I think all of us got
a long time ago, back in the early 80s.
You know, it's certainly telling you my age. But I've been in the boardroom for over 15 years, helping directors understand Sarbanes-Oxley. I've chaired the committee of corporate secretaries that actually designed the implementation of the more practical aspects of Sarbanes-Oxley. So I've really lived with the practical as well as the communication with investors. Needless to say, we are now very well known by virtue of the number of shareholder proposals that we get. And I guess to respond to some of John's comments, I certainly can recognize among my colleagues and what I had understood my job to be. I didn't grow up a securities lawyer, I was a regulatory lawyer. So when I had my first annual meeting and my colleagues were coaching me on what an annual meeting was, and it certainly wasn't a referendum or a discussion or where decisions were made where, you know, you were really interested in trying to do whatever question came up. I too was puzzled by the model that was then embedded in corporate governance, that you very much want to get out of that annual meeting and you don't want to answer any questions, and I personally don't like that model. So but shortly thereafter, I think some of the polarization, as I recall it, was when proxy advisors, several of them whose names are familiar to you all, became trusted when they were first formed, but then when they became trusted by their institutions. And in some cases, their recommendations are followed because the institutions may not have the resources to analyze all of their votes themselves. I think there was an awful lot of advocacy on the part of the proxy advisors that got issuers to be less receptive. The CGQ score was a grade that was assigned to you. And when it came out, no one really knew what it meant, who would rely upon it. So there was this fear that if you got a bad grade, you had no idea what the vote was going to come in. So an awful lot has changed since then, and I think most of my colleagues are very proactive in discussing proxy issues as well as corporate governance practices with their largest institutions. For example, we have now a very formal annual campaign of attempting to have conference calls, individual conference calls with all of our top 50 investors. And as I said, that's over 50% of the votes. Through that process, I have come to know well that portion of our institutions who vote the proxies. One of the issues, I think, is that, and I guess it's in this, the chart that John had, all investors are not the same. And those with whom I speak generally are supportive of the company, are willing to listen. They may not agree with you, they may not vote your way, but they're always willing to listen, and generally they will have principles there But the agenda is not to conform everyone to those principles. And I think some of the concern, especially now that we have some of these issues on the back burner, now the front burner, that issuers have been concerned about, it's become, there was this period of 2 years when this dialogue was fantastic and everybody was talking to everybody and negotiating shareholder proposals and adopting things that institutions wanted. But I fear that the agenda that is being more than promoted, executed by proxy advisory services may be putting us back a step or two. Hopefully it won't continue or carry the day, but we're very interested in our institutions, and largely they are handled by investor relations group for the for the analyst calls and day-to-day conversations. So there's an awful lot of communications on the analyst side and the buy and sell side analysts. Our communications tend to be during proxy season, but we ask all of our institutions, how often do you want to hear from us? We have tables at our investor conferences for anybody who wants to talk about governance. The analysts, usually I'm the last person they want to talk to because they'd much rather get some quantitative information to plug into their model. But we're very, very proactive, very interested in what our shareholders want us to do. So what are the issues as we see them? It would be nice if institutional investors staffed up to talk to issuers. When Say on Pay was first introduced, and as I said, we try to talk to the top 50. Last year, I got calls with 17. Why? They're very busy. If we weren't an issue, they didn't have a half an hour to talk to us. We are large enough so that we get an opportunity to see in advance recommendations of some of the proxy advisory services. Some of the smaller companies don't even have a chance, and some of them can't get investors to answer their calls. I think, John, your point about looking in the mirror, I've asked this question about Say on Pay. If we have to interpret the results of this vote, how do we do that if those who voted against, or in whatever way they did, if we can't understand what the vote meant? I think you're going to be seeing more stratified or detailed resolutions, I hope, because I fully expect Say on Pay to be legislated, if not adopted by the SEC this year. Is an up and down, what if you were a shareholder and you saw the amount of compensation that these folks are paid, are you going to say, yeah, that sounds good to me, let me sign up? How do I get in line for this compensation? So what do you make of the vote? How do you act on it? If you don't know, is it because the CEO's severance is too high? Is it because it's just altogether too high? One of the issues that is particularly hot for investors these days is something called excise tax gross up. And it's very hard to explain other than that if you're in a competition for these top CEOs, you're probably going to pay what you need to pay to get them. And if the compensation consultant says this is the package of various elements that are this is the market rate, this is what is appropriate for your compensation of your CEO, the fact that there is you're willing to pay the tax that would otherwise be due on executive compensation above, what's the standard, 100,000 or a million? Million.
Yep.
That's the hot issue, and was the reason that one of the proxy advisory services recommended a vote against our entire compensation committee, because one tiny element of the CEO's contract that had been in place for 16 years was that one element. So it's hard to talk constructively with people who have that strong and narrow an agenda. That, I think, is one of the issues that we see. I think that splitting the CEO and the chair, our company has always taken the position that it depends on the person. All of you know different CEOs, and some are forthcoming. In our culture, the first thing you do is admit all the mistakes that you made, and then you say what we're going to do to fix them. So our CEO is very forthcoming about problems, and if you had a CEO who wanted to hide the ball, I wonder how a non-executive chair would discover that. Of all of the people who are best able to present only the good news, certainly a CEO can do that if that's what they have in mind. So in our company, it's not given that it's combined. It depends upon the people involved. And I suspect the minute the board didn't have confidence in the CEO telling them all the truth and nothing but the truth, and especially the warts, you might see a change in that. But the other thing is the lead director role is very effective. The counterbalance of that is the executive sessions, the directors kick people out of the boardroom without even a bat of an eye. Yes, get out, you get out, you get out, you get out. Whenever they want to talk privately, they talk privately. And they always, whenever anything about the CEO is considered, they listen to the CEO, send him out of the room, talk about it as long as they want. They'll bring him in to say what the result is, but the lead, we haven't really given the lead director long enough, I think, to conclude that they're ineffective on the CEO. I agree with John on the shortism of Wall Street and how it has impacted companies. But I'm not sure companies are so tied to meeting the street's expectations so much as they're concerned about not meeting the guidance that they gave 6 months ago. So that certainly our guidance has always been under the street expectations, so we're used to managing that gap with investors. But meeting an earnings per share target, an internal target, something that you set, the reality is if you don't meet it, your stock does drop. How can you expect a senior management team not to notice how close you're coming to your own projections of your long-term plan? And the only other comment I would make before passing on is that I agree with the elements of the chart, but unfortunately there are so many more constituencies than just the shareholders. Our company being regulated, probably the regulators, state and federal, wherever they are, have more influence over us on a day-to-day basis than institutional shareholders. And they're the quickest to hurt you. They're the last to help you. So following that is our state and local politics, legislators. You might have read about a particularly well-publicized dispute that we had in Illinois recently, where we had the misfortune of having probably the head of the state legislature and the governor and everybody else lined up against us. But what was interesting is the legislature can pass a tax that can hit you, and you have no real legal defense against them deciding to pass a tax. And that was the unfortunate leverage that existed. So you can't ignore the legislators, the politicians, the customers, the employees. There are so many constituents there that the directors and management have to manage and balance their interests. So look forward to your questions.
do have 1 or 2 slides. Yeah, morning. Thanks for the invitation to come and talk today. I'm going to focus a little bit more on Katherine's issue of executive compensation, and hopefully the title of this talk may give you a little hint about where I'm coming from. So I'll tell you what I think we know, and then leave it as a sort of a question about what indeed is all the fuss about. If you're a CEO in this country, you can earn a lot of money. I don't think I'm bringing any news there. The chart, slightly blurred chart, suggests that on average in fiscal 2006 in the Fortune 500, your CEO earned about $8 million. The questions on the left are more provocative, and I can give quick answers to that, to some of these other ones. Yep, the US economy has done pretty well. Are they overpaid? Is, again, a very provocative question. I think there's undeniable evidence that pay is linked to performance, as much as some people would like to convince you otherwise. Is the pay-setting process dominated by insiders? Again, I think a lot of the reforms that we've seen in the recent past have actually done away with a lot of those concerns. And actually, what we're seeing now, and particularly with the recent downturn, is that the pay is coming down. What you see on this graph is sort of institutional changes related to the expensing of stock options, which completely drove the explosion in pay in the early 90s. Now becoming much more transparent, and pay has come down, and in this fiscal year, bonus plan arrangements are going to be hit particularly hard. And again, I expect overall executive compensation to come down this year. I think it's important to realise how is pay set? Who actually sets executive compensation? Institutional shareholders clearly don't. They don't set pay. They delegate that responsibility to the board of directors. And slightly problematic for some people is the idea that the CEO sits on the board of directors. So now we delegate the responsibility to a subcommittee of the board, the compensation committee, made up of entirely independent directors. But clearly there's some interactions here between the various parties. And one that Katherine also touched on, that I know a little bit more about, is the role of the supposed independent compensation consultant in the whole process. And I think if you're looking for villains of the piece, these guys are probably your prime suspects. But nevertheless, I think that sets up the overall pay setting field. It's an iterative process, a lot of give and take, a lot of negotiation between the board, the comp committee, the consultant, and the institutional investor's role in this should not be downplayed, and I'll speak a little bit about that in a second. I think the growth that one of the few phenomena that actually mirrors the growth in CEO compensation is the number of articles written by academics and other people about CEO compensation. Now, given that my two colleagues on the panel have day jobs, and for hopefully most of you, life is probably a little bit too short to wade through the volumes of articles that have been written on this subject. Let me try and sum it up very briefly. There's a broadly positive relationship between the amount of equity owned by institutions, and the pay performance sensitivity of executive compensation packages. How does this come about? This comes about because almost entirely through institutional investors' relationship with loading up their executive companies in which they invest, loading them up with option grants. The flip side to this is that it obviously imposes more risk on top executives in these companies, and so the higher pay that we see in companies where there are, large degrees of institutional ownership leads to is an outcome of this loading up of the executives in these companies with stock option grants. Again, if you want a number, just one of these things that if you're working in this field, you're a little bit too dull and have too much time on your hands, but about a 6% increase in institutional ownership is associated with a 20% increase in the pay performance sensitivity of the executive's compensation package. So, increases in executive in institutional ownership are significantly associated with increases in pay performance sensitivity. I think it's an interesting question as well whether what economists call a clientele effect exists, in the sense that do companies adopt pay packages to make themselves look good to institutional investors? So actually what you're seeing here is, we've adopted this in order to get institutions to invest in us, or is it the other way around? I think it's important to try and disentangle that. And I think when you throw some fancy statistical techniques at data, the effect is the other way around. It is the effect is moving from the institutional shareholders influencing pay practices rather than the other way around, rather than pay practices becoming attractive to institutions. So that's what I suggest here. The ownership predates the outcomes in incentive compensation. There's also some evidence that there's some work that looks at where companies have to go to their owners for approval for the implementation or significant change of executive stock compensation plans. And we see that there is some evidence that institutions will vote against plans that lead to excessive shareholder dilution, what's considered excessive, and particularly when organisations like John's flag this up as an issue, where the proxy advisor gives a negative recommendation. As Katherine said, you'll normally see the institutions go along with that, particularly when it's combined with what's considered, inverted commas, excessive dilution. So I'm painting a broadly positive role, I think, about the relationship between institutional ownership and executive compensation. You kind of get what you want. If you want to have more pay performance sensitivity, then institutional shareholders are one mechanism by which this occurs. Nevertheless, there is, as John hinted, there is a feeling out there that these guys are not on the side of the angels, they're on the side of the devils. John actually cited this report that I didn't realise he'd co-sponsored, to be honest, but he neglected to actually mention the title, which is Compensation Accomplices. There's obviously a feeling in which there's some sort of conspiracy going on here between the institutional investors and the compensation committees, and these reports, they come and go, and my grandmother once said, if you can't say something nice about something, don't say anything at all, which wouldn't make for a great presentation, but I think particularly that report, some of the analysis contained within it would not pass muster in some other forum. So, I think it's debatable. I think, some of their key findings, that our report finds mutual funds are increasingly supportive of management positions on proposals dealing with executive pay, despite the current outrage over CEO pay amounts and disconnection from company performance. It is a conclusion I couldn't support when I looked at this particularly. I found that I couldn't see the logic with that. But again, this is something that, the AFL-CIO clearly has, an agenda that they're pursuing. But on the other hand, companies aren't blameless here. Again, just yesterday, BP, there's rumours of some shareholder disquiet amongst compensation arrangements at British Petroleum. And a quote from an insider there yesterday, institutional investors felt under pressure to take a robust line with managers they invest in after the financial crisis has highlighted mismanagement at so many public companies. Which kind of begs the question, thanks guys, but where have you been? Why does it take this to actually make the institutional investors take notice? I mean, surely this is something they should be doing more of. So they're not blameless in this. I'm painting a broadly positive picture, but I don't think they're certainly not blameless. Again, there is this feeling that the CEO pay is not driven. There's no market for CEO pay. A feeling that that it's a cosy collusion amongst people at the top of companies, and this is a view that's been particularly strongly articulated by Professor Lucian Babchek in a book and a suite of papers. But I think the interesting thing is the extent. He calls it outrage. He suggests that one of the things that constrains pay is just outrage. And as Katherine alluded to, we have in other parts of the world a way of attempting at least to measure this outrage. If, in other parts of the world and on the agenda here, we have the ability to see, well, what actually happens when investors are able to actually have a much more direct effect on compensation matters. Since 2003, when there was a change in the Companies Act from 1985, the remuneration or compensation committee report, called the Remuneration Committee Report in the United Kingdom, has been the subject of a vote at the annual stockholders meeting. Similar measures exist in Australia and Sweden, and because the government has had one or two other things on its hands recently in this country, it's currently held up in the Senate. Although it's useful to note that increasing number of companies are doing it here now, voluntarily. So I think about 70 companies now at least are voluntarily putting this up for a vote. Interesting to note that the vote is advisory. It has absolutely no effect on monies paid. There's no mechanism for trying to get the CEO to sign a cheque on the way out of the door of the meeting, reimbursing the company. It's purely advisory, but it does give us a feeling of the level of outrage that exists, and presumably this is something that companies are interested in. Any well-governed company like Katherine's would be interested in knowing how the shareholders feel. I've done some work on this. So I've taken the data from the largest companies in the United Kingdom and seen, well, what's the effect of this? Or what's the evidence suggest here? And the results aren't particularly interesting, to be honest with you. When you're trying to write papers and get tenure, this is not going to get the job done because they're not wild. Votes for dramatically outweigh any sort of dissent against compensation packages. So in 2003, 345 votes went from 85 to 94% in favour of accepting the Compensation Committee report, part of the annual report and accounts. There have been no cases over that time period in those companies where there was more than 50% vote against. One company, the Vodafone Group in the UK, had a significant 49% vote against. The consultant got fired. It's all the consultant's fault. That was the only significant change that happened between the 2 years. There's little evidence that actually suggests any wholesale changes in the way the CEO and the executives get compensated. I think John mentioned the word tweaking, and that's exactly what I suggest here. Maybe some tweaking about metrics, moving from, say, an accounting standard, an accounting-based measure of performance to maybe a more equity-based measure of compensation performance standard. Maybe some movement, increasing movement away from share option style plans to more restricted stock style plans where company performance is evaluated against a comparator group. But no wholesale changes in the way CEOs are really compensated. And let me just finish with this. What is all that just? Is it a smokescreen? Is it parsley on the fish? Is it something that really is not particularly helpful, necessary, and we could be spending our time doing other things? What do well-governed companies already do? I think they constantly engage with their key shareholders on the efficacy of executive compensation schemes. Any proposed changes coming down the pike, you talk to your key shareholders about this, and it is a conference call. It is a backwards and forwards about these things, because companies don't like surprises at the stockholders meeting. By that time, it's a bit too late. They want to do all the work in advance and ensure, as I suggest here, a surprise avoidance strategy. That said, it strikes me that institutions should be at least willing to explain their positions a little bit more. Again, I think that speaks to John's point, particularly to their investors as well. Why do they just blindly vote with the management proxy, for instance? Why do they do these things? Why do they have particular faith in that position? And again, I think, maybe speaking to John's point, suggests that some of these institutions need to have better, what I call monitoring type skills, the skills that are associated with being able to judge good governance arrangements, rather than just being able to judge, the discounted future net cash flows of any particular strategy and whether that's reflected in the share price of the company. So maybe those sort of capabilities, those sort of skills are ones that institutions could develop a little bit more. But again, it comes back to my previous slide. Where do we think the problem, the extent to which the problem exists, really lies here? The focus of today's session is on the role of the institutional investors. I think when we think about compensation matters, I think you can't neglect the committee, you can't neglect the compensation consultants. And more of this suggests, if it's, these are made up of people, and they're only as good as the people on them. And I think some of the more interesting reforms are actually targeted towards the issues of board composition. Some of the changes about trying to make it easier for investors, institutional investors, to nominate directors to the board, rather than just the management slate getting passed blindly every time directors are up for re-election, is something that could be particularly positive if you're genuinely concerned with the way executive compensation is set and determined in these companies. Thank you.
George, can I respond very, very quickly
The
to
rest of this
the
is
points?
for colloquy, questions and answers, and I told the speakers I would first, the first two speakers, I would first give them a chance, ask them if they had any reply to anything that was said after. So, Chef, please
Sure.
go
So
ahead.
very, very quickly in response to a few of Kathy's points, I think she makes a very good point when she says that the company has to deal with lots of other constituencies and the shareholders, and that the corporate governance triangle doesn't include them. That is very, very true. I think that all of those other constituencies belong on the management category, because running the business is their job. That is the enterprise itself included on that axis of the corporate governance triangle. There are lots of other groups in there. And I would urge understanding that shareholders are becoming increasingly sensitive to other constituent groups, in particular on issues such as sustainability, the environment, human rights. Those issues are starting to be viewed by shareholders not as gadflies, special interest issues where they've been for many, many years, but as central strategy issues for the corporation. And here again, a director-centric company will require that the board of directors oversee and understand how the management and of the company and the enterprise itself is dealing with these issues, because these issues, first of all, offer opportunity for competitive advantage at the company. If they operate green, they're going to increase customer loyalty. But there are also risk control issues. Operating green may mean the avoidance of regulatory penalties, litigation, unhappy customers, all kinds of things. So these issues are increasingly viewed by shareholders as issues of business strategy and not just moral issues the way they've been discussed for the past 15 years. So you're absolutely right. Running a business is a complicated operation with lots and lots of different constituencies to be addressed, and of course the customers are always the top of the list. But shareholders need to have greater insights into how that is being done and how it is being overseen by directors. The split of the chair and the CEO, Kathy gave a response that I've heard many times, which is that they want to take a flexible approach, and it depends on the person. I think that I feel that it should be structural simply because of the way I feel that the role of the board of directors is evolving and involves more and more sensitive issues, and you're putting the CEO into an awkward position by asking him or her to wear those two hats. But I also think that if you are flexible, then you automatically downgrade the CEO who does not get the title. And why should that be the case? I think that that the lead director role also is in a way, and also having executive sessions of the board, these are all good things. But I don't think that the lead director is really a substitute for a structure in which it's absolutely clear what the role of the board of directors is, including its chair, especially its chair, and the role of the people running the business. And that's really the function of it. You're absolutely right that institutional investors need to staff up to deal with their responsibilities with respect to their role as owners of corporations, and not as many do that as need to. TIAA-CREF, for example, has a group that I headed while I was there, which operates under the General Counsel. Others do this operation under their asset management. There are a lot of different models. It is extremely hard for corporations to find out who those decision makers are. It should not be difficult. It's easy for them to find out who the analysts and the portfolio managers are, and their IR relationships and investor relations relationships are very clear. But the relationships in the areas of policy and share voting are very unclear, and we need to do something about that. With respect to CEO pay, we can talk quite a lot about that, but I think it's very important to understand that the question that shareholders are interested in is how executive pay works, how people are being paid, not how much. How much is a question for the board of directors to answer. And shareholders don't want to answer that question because they don't know how to answer it. They cannot make those judgments. They do know when they think people are being overpaid with respect to performance, peer companies, etc. But their anger is directed at the board of directors for not answering the question or justifying the numbers. And very often the response is, well, we have to be competitive, there's a market, and so forth. But when you analyze the market for CEO pay particularly, it is made up exclusively of participants who have an incentive to see CEO pay get higher. It is the compensation consultants who are paid to be creative and to find new ways to pay people. It is executive search firms whose fees are directly proportional to the amount of money paid to the CEO that they get hired. It is boards of directors, many of whom are themselves CEOs, not all, but who have to supposedly take off their CEO hat when they're judging the pay of a peer. And it's very difficult for them to do that. The only group that is going to run counter and create a true market are the shareholders, and they don't have a voice. But the most important point is that shareholders do not want to be in the boardroom making decisions about how much, but they want people to be paid fairly. And escalating pay is also often the result of failed succession planning, another board duty. The classic example of that is Home Depot. They allowed themselves to, they hadn't done adequate succession planning. They went outside, they hired somebody from GE at a pay scale way outside of the company, and it was a disaster, both culturally and operationally. I believe that many boards do not pay enough attention to the issue of pay equity. A corporation is an enterprise. The role of the CEO is the leader of an enterprise, a team leader, and when the CEO is paid off the charts, when his or her pay is not related to the pay of the people within the corporation, you have a problem. Let me read you something about Peter Drucker, whom I think most people respect. Peter Drucker thought that top executives shouldn't get more than 25 times the average salary in the company. Well, we're way off from there. We're 300 to 400 times now, 344 at the time this article was written. But Peter Drucker's, and I quote here again, view was rooted in his belief that the best leaders are those who understand that what comes with their authority is the weight of responsibility and not the mantle of privilege. It's their job to do what is right for the enterprise, not for the shareholders alone, and certainly not for themselves alone. We have had some problems in this country for the past 15 to 20 years with superstar CEOs for whom the job has been about the mantle of privilege and not about the weight of responsibility. The stewardship model for the CEO has gotten lost here. As we celebritize everything in this country, the CEO suddenly becomes a rich, glamorous person who's paid like a movie star or a basketball player, and that doesn't help companies. This again from Drucker, the chief executive officer has a special duty to show that he or she is just a hired hand. That's what today's CEOs have forgotten.
Katherine, do you want to?
Well, I guess the only response is that we're in a marketplace in the United States. Say that to the NBA, say it to the actors, say it to it is what it is. And if you're in the position of trying to attract someone that you think will help your company and achieve its strategic objectives, it's hard to have a limit on or a particular only one structure that you're willing to pay to attract them. I do agree on one point. If you look at this crisis, actually this is not an agreement. I've read those who are contending that this financial crisis was all about CEO pay. And had the individuals not been incented to take the risks they had taken. We have a very strong risk oversight committee of our board because we do some financial hedging transactions with power trading, and there's some risk involved in that, and the board wants to make sure that they have a handle on that. I wish that the dialogue were more about how can the board effectively understand the worst case scenarios of the products that they're selling or the other work that they're doing, those risks, because I think that dialogue could be a lot more productive than it's easy just to say it's because these guys are paid too much. But I've even understand someone has shown a causal or some kind of a statistical correlation. But I wish the dialogue were more about how to manage risk than how much are we, it's the same old saw.
Well, I'm going to ask for questions from the audience, but I have a lot of questions myself. I'll hold most of them, but I am going to exercise the prerogative to ask one question. I'd like to ask a question to Simon Peck, although it isn't a deal exactly that he talked about, but he is the only non-lawyer and the only finance expert in the symposium. And both John and Katherine referred to short-termism, and Marty Lipton has referred to investors who are out just looking for a short-term pop in the stock price. And this baffles me a bit, because we learn from the basic corporate finance texts that a large market like the New York Stock Exchange is efficient in that it quickly impounds all available information, and that market prices are an unbiased forecast of the present value of all future payouts. Nonetheless, the critics of many institutional investors, like Marty Lipton, and the Delaware Supreme Court are notorious in their contempt. Oh, it's just market price. It's just, people playing games there. That means nothing. And short-termism, I've always wondered, what in the world, if you were a short-termist, whatever that might be, what in the world would you try to do? The long-term is just a series of short-terms. So, and does this notion of short-termism make any sense to you, Simon?
No, it's entirely.
I didn't think so.
No, it's entirely bogus. I think people are short-termist. I think particularly, when you say you have to get re-elected every year, or if your compensation contract is poorly structured in a way that provides you with incentives to behave in a short-term manner, then you do get short-termism on the part of people. But no, I don't think the market is inherently short-termist, because as you just accurately said, if there's no difference between short-term performance and long-term performance. If you consistently think there is this difference, then you should be able to beat the market. You should be able to devise some relatively straightforward strategies that would allow you to take advantage of that inherent short-termism. And we wouldn't be sitting here if that was the case, George. We'd be doing other things, being very wealthy in other things, doing other things. So no, people are, markets aren't, I don't think.
George, I'll give you a view on this. Long-term investors like TIAA-CREF are long-term until the opportunity for short-term gain arises, and then they'll take it. The issue is more on the corporate side, I think. The market is what it is, and it's diversity, and there are people who are gamblers in the marketplace. There are people who do arbitrage as a form of investment. Nothing wrong with that. There are short sellers. They all have a role. I think our next panel is going to talk a little bit about some of the implications of that. But from the viewpoint of the corporation, I think the issue that we have been concerned about is a very legitimate one, and that is when the corporation manages its business with an eye on the market and uses accounting mechanisms or accounting manipulations in order to meet these sort of arbitrary market demands, which really don't have anything to do with the running of the business. And the concern is that businesses generally do not have smooth courses. You have to invest capital. If you're running a capital-intensive business, you've got to raise money. You've got to build a plant. That's going to increase your costs and reduce profits for a certain time period. But and research and development, those expenses are necessary, and you have to think ahead, and you have to take risks and so forth. No one should expect that the profits and the quarterly earnings of a company are going to be smooth. And the fact that all these businesses for decades, like Bernard Madoff, had a very, very steady return is something that we thought was just great until we found out that it was all a sham. So the expectations that are put onto businesses by the marketplace need to be resisted so that the companies themselves don't start to distort their basic strategy and operating decisions.
Yeah, I was just raising the question about the argument that the corporation needs to be insulated from these terrible institutional investors who are just looking for a short-term pop in the stock price, which, as I think Simon has said, that's
right. Well, they can't be insulated. They've chosen to operate in this market. It's their responsibility to deal with it as best they can.
Okay, go ahead. Yeah.
The only caveat I would add is that because of the share lending and the ability of these synthetic owners or whatever they are, it's very difficult for issuers to know who their owners are in that aspect. And also, as the CSX case showed us all, it's easy to be ambushed. The 13D filings are not always there. And so it's very easy to be surprised and very easy to be concerned about probably the people whose interest is very different from a TIAA-CREF or a long-term investor.
Right, and transparency is much to be desired on the part of the market and those kinds of shareholders.
Yeah, we're going to be talking more about this divided interest in shareholder voting in the next session. We have just a few more minutes, so questions? Yes.
I'm struggling, actually, initially. You guys keep describing these institutional investors, and I will tell you, TIAA-CREF really actually is a collection of individuals' money, and that is a decidedly different vote, assuming TIAA-CREF is voting its shareholders' shares, than a hedge fund manager or actually a direct pension fund which votes the shares, and or Berkshire Hathaway or whoever owns a reportable entity in Exelon. I doubt there actually are any. Can everybody hear me? So I'm struggling with the difference between having Vanguard own your shares because they have Exelon Exelon's probably in 25 different Fidelity funds, Merrill funds.
Okay.
That is a decidedly different institutional shareholder than George Soros.
Well, actually, it isn't. It isn't because it isn't different. Ultimately, everyone is the money of people like you and me. Pension funds siphon money into hedge funds. TIAA-CREF does represent 3.5 million participants, but the voting decisions are not passed through. They are not made by those 3.5 million. They are disclosed to those 3.5 million participants very promptly, but they are made by the group that I head and by the trustees of TIAA-CREF. The same structure is in place for Vanguard and other mutual fund groups, except that they...
Trustees looking at the shareholder resolutions at Exelon and saying, yeah, we should build, we should paint all our trucks green because green's a happier color.
Yeah, they basically, if you look at TIAA-CREF's website, you'll see there's a set of policies there dealing with a variety of issues, some of them very specific, some of them more generic, but those are policies established by the trustees. Other groups have different decision-making mechanisms. For example, Fidelity involves its portfolio managers in policy issues, whereas the TIAA-CREF would go to the asset management group only if there was an economic issue where their input was needed. But in the end, the dollars ultimately are the dollars of America's citizens, whether they've invested through pension funds or...
We have to give somebody else a chance to ask a question, okay? Another question? Okay, David.
I was going to say, maybe to clarify, I think what Stuart is saying is that referring to institutional shareholders as a monolithic group may not be correct. That they have different investment motivations.
Of course, they're very diverse.
But we use the term as though there's this single blob out there of institutional investors. The reality is that, as Katherine's company experiences, that when they talk to 50 people, if they can talk to 50 people, they will get different viewpoints on some of the same issues. And I think that, Stuart, am I right?
Right on.
Okay.
Well, diversity is a given. I mean, that's
Before you respond to that,
ABC.
could I just add something to that? Now, obviously, people can have different predictions. We're rooting for the Indians, and we might have different feelings about whether we should pinch hit for somebody. But we all want the team to win. Now, the institutional investors may have different attitudes about what tactics should be taken, but aren't they all looking to maximize the value of the equity?
Sure. I mean, I would think so. But again, there are different views about how you accomplish that. And frankly, there are shareholders that are highly visible, like Carl Icahn, who is mistrusted by other investors because he basically does what's best for him, not what is best for companies or what is best for other shareholders. Those distinctions are really commonplace. And of course, the challenge of a company is to deal with this diversity. I don't consider it to be an overwhelming challenge because companies deal with an incredible amount of diversity in their customer bases, for example, but they approach it with a very constructive attitude instead of with a defensive and adversarial attitude that they bring to shareholders.
Well, since we started, well, all right, we'll take one more question, yes.
Use a term which is much abused and much misunderstood, but the average American. I would think the average American 50 years ago when Charlie Wilson said, what's good for General Motors is good for America, I don't think many Americans thought that was an arrogant statement because they didn't really care what Charlie Wilson made because they thought he deserved it. I don't think the average American today thinks what's good for General Motors is good for America because General Motors is gone. And so the average American says, well, what happened? They're looking at the ratio. This is what Mr. Wilcox talked about, the Peter Drucker talking about the ratio between the general's pay and the sergeant's pay. I mean, how did that ratio get so bent out of shape and with such total lack of stewardship and fiduciary duty? That's why the average American is going to has lost all confidence, and that's a morale question for the future. And they have to really get back to the ratio issue.
Okay, let's let the panelists respond. Okay, go ahead.
No, this ratio that gets bandied around is the worst sort of populist sort of nonsense, really. Actually, in China, in mainland China, it's actually legislated that the gap between the CEO and the average worker is 15 times. So Peter Drucker will be delighted to know that he has the ear of the Communist Party of China, I would have thought. But no, you tell me what number you want, and clever people.
It's not nonsense. It has to do with how well a company works and how a team works. And we drifted very, very far on this. But the issue is not one for shareholders to resolve. It is for directors to resolve. And directors have allowed this to happen knowingly. And it's been driven by a lot of forces, such as comp consultants and so forth, that have basically ratcheted up the pay. And it is a very serious social issue in a sense, and it has to do with business credibility, and companies need to think about it as a credibility issue. It's something that in this country is quite problematical in terms of our values as a company, as a country.
Okay, well, our time is up, and I do want to try to stay. No, sorry. I want to try to stay on schedule, so we'll begin the next session at 10:45. But I want to thank the panelists here for, I think, a really excellent session.